Today, my guest is Vinny Chopra. Vinny is a returning guest to CREPN Radio. He's a successful multifamily syndicator. He's done over 20 successful syndications. And today we're going to do another deep dive into multifamily real estate investing. Our topic today is underwriting the deal and deal analysis. But first, a quick reminder, if you like the show, please let us know. You can do this. You can leave a comment. You can like, you can share. And always, please consider subscribing to the show. Also want to remind you, if you would like to watch the show, you can check us out on YouTube. Our channel is Commercial Real Estate Pro Network, and you can see myself and the guest interact. And now, Vinny Chopra. Vinny, how are you doing?
I'm doing great, Darren. How are you?
I'm good. I am really good. I'm looking forward to our talk today to talk a little bit more in our series of multifamily conversations here. But before we get into it, if you could take just a minute and let listeners know a little bit about your background, and then we'll get going.
Sure, Darren. I came from India, as many might know now, or the new audience from India. About 40 years back, with $7 in my pocket, I sold Bibles and encyclopedias to go to school, George Washington University. I did my mechanical engineering in India, but then I did my MBA in marketing. And by doing so, I just loved the marketing and sales so much that I just left engineering behind many moons ago and became a promotional consultant, motivator for most of my life. And also we were investing in real estate, single family homes. Actually, by that time, we couldn't afford multifamily. I became a broker in 2004, 14 years back, and just wanted to get into commercial side of the business. And lo and behold, I got the bug. I caught the bug about multifamily. It just made sense to me, being an engineer. And we have not looked back. 14 years we have done, in 11 years, we have done 26 syndications. Had about 3,100, 3,500 at the peak units. And we have sold 10 of those assets, comprising about 250 million. So,
Wow.
yeah, quite a lot. And 12 of them have come in the last 3.5 years. So actually, it was a slow start with my partnership with another company. And then I became my own company, 100% CEO. You can do a lot more things when you have nobody to answer to, or have,
Right. Well, you really are the American success story.
Oh my gosh. Oh my
Coming
gosh.
from foreign land and just $7 in your pockets to 250 million in real estate, and I mean, it re-illustrates, and it's always something I come back to, is just the power of real estate and the opportunity that exists in real estate. And I
Sure.
think that's a great reason for the listeners to be excited to hear more about what we're going to be talking about today. And I know I'm excited about it, because I think this is where a lot of investors, whether you're new or you're trying to figure out a deal, this is really kind of where you can determine if it is a good opportunity, and kind of really set. And I would also add to that, and I'd love to hear your thoughts on that. But how much of the opportunity is at the buy as opposed to the sell?
That's a very good point. I have always felt that you have to find the best deal, especially as a syndicator, which where I live in, all the world I've lived in, and to safeguard the money of the investors is such a big thing. We have fiduciary responsibility that when our friends or relatives or our colleagues give us the money, they entrust us to take care of it and invest it in a good deal. We call it a deal. Actually, it's a great opportunity that is going to grow in value. If I may really stress that, it's so important that we look at the emerging markets. There are so many emerging markets going on, even right now in USA. Even in the tough time like we have today, market is tight. Not too many apartments are on sale. People are kind of holding back. Also, the interest rates just rose, and there'll be two more times coming up. So a lot of times, we can kind of get out of the ball game. We could say that it's so tough and everything, let it subside, and maybe I'll wait for a year or 2 or 3 years. I'm not with that notion. I'm with the notion that when people get out of the game, that's the time you want to stay in the game to really pick up some great deals. We are looking at three pocket listings, right now, where nobody knows. I call them napkin listings because, these brokers don't even have it in their pocket yet. It's only on the dining table or, coffee table on a napkin that seller are looking into selling, their asset. So I may say that definitely the deal has to make sense on day one. And one thing I want to stress out to the audience is a lot of time people have asked me over the years, Vinny, what cap rate do you buy? What's the minimum or the maximum cap rate? How much IRR are you looking at? I try to tell everybody, look for cash on cash return. That is the main mantra of finding a best deal, is to look at what's the cash on cash right now totally, and then how will that cash on cash grow for the next 5, 7, 10 years. And that is the best indication not to really speculatively buy at this time of the, where we are in the economy, but look into if the numbers make sense today, and we need to really stress those numbers with a lot of precautions. That's the other part, which I'll be discussing today in our underwriting, extensive underwriting templates that we have designed when I got trained about 12 years back from my mentors and coaches. They gave us like one sheet, and we have added so many different worksheets to look at all aspects of the deal and in a very comprehensive way. So hopefully I can bring that, and also your audience will be getting that free, by the way, and they could actually, I'll give an address and they will get that $200 worth of product for free, just a thank you from my side.
Got it. Hey, before we get running down this, you mentioned the cash on cash
Yes.
return. And I'm assuming that that's going to be kind of a reference point as we go forward today. What can you, for the listeners that don't know, can you just briefly describe what cash on cash return means?
Surely. What this really means is the cash on the top, and then we divide the cash at the bottom. That's the ratio. But what's the cash on the top is the net income that we are realizing at the end of the year in 12-month period, after we collect all the rents, all the different incomes from the apartment, units, and also RUB system. I want to say that RUB system is the one where we bill back the utilities to the residents, and they pay. So that's income also. Laundry income. All those incomes are collected on the top. We take out the vacancy, take out the loss of lease. I'm saying a lot of different words when I would love to explain them. So total income, let's just say, minus all the expenses of the running of the properties, apartment complexes, insurance, tax, all those will go into detail, minus the capex, minus the mortgage, and also the principal and interest. So this is the cash that's we can take to the bank, I call it. This is the cash at the end of the month after we have paid everybody. So that is the net income or cash we get in 1 year. Divide that by how much did it cost us to get into the property? How much did it cost us to pay the down payment, to pay the closing costs, to pay the insurance fees, if we, legal costs, acquisition fee, all those things we can kind of explain. That's all explained in very nicely in a very extensive worksheet that we have been able to utilize and work on and improve upon for the last 10 years. And it just changes numbers correctly in every facet. And it's very, very comprehensive. But then let's just talk about also when we divide the total net income by the total income we put into it, that's cash on cash.
Gotcha.
And at the day one, I have bought properties, I would love to tell the audience, 17% cash and cash, 18% cash and cash, 12% cash and cash, and now the market is a little bit tighter. So I've reduced that number to about 11%, even 10% cash on cash. Because the thing is, if you're giving 7% or 8% preferred return to the investors to invest with us, we need to make a little bit money because it's a awesome responsibility. We are on the loan, we are finding the deal, we are running the, asset manage the deal, we are managing the managers, everything. So a lot more goes on as a syndicator because we are now buying the property today. We're going to be managing it for 3, 5, 7, 10 years, maybe even longer. But that's where we want to see the cash on cash of at least, I would say, 10.5 to 11% now.
Gotcha. All right. Well, I appreciate you taking us through that because I think that if that's our, one of our more critical measuring sticks, it might be important to have that understanding as we go forward today.
Totally.
So you mentioned, and I'm going to let you kind of tell me which direction you want to go. But you did mention emerging markets. We got talking, cash on cash is obviously a financial analysis. Assuming that at some point we want to talk about the property itself. So tell me, where would you like to start?
Surely, a good deal. I think the biggest thing is that as an investor, if we are buying for ourselves or we are a syndicator buying for our team of group of investors, and we are the manager of the LLC that's going to purchase the property, multifamily, we need to be looking in emerging markets. I have always felt that I've stayed true to my mantra because we have paid out to our investors 18 to 43% per year. That's a lot of money for somebody to just pay 100,000 into the investment. And in one of the deals, I gave them back 100,000 back plus 202,000 on top of it. Wow. So they were really smiling, and they were my early investors. They told more friends and more friends and more friends, Darren. It's amazing how my mushroom, the whole base has increased a lot, because if you get a good deal and the investors get those returns quarterly, we pay quarterly. Some people pay monthly also. We pay just 4 times a year to our investors, walking to the mailbox and picking them up. And that's what they love, because they don't have to get too much involved in the day-to-day operation. They don't have to be on the loan. They don't have to have the risk is that if I lose their money, which we have never lost money whatsoever. But you're right. The key thing is emerging markets. If we can figure out a good deal is where we can add value to it. That's why we don't buy A-class buildings at all. Never. Because there is zero different maintenance, and then mostly we cannot add too much value to the rents. When we say add value to the property, is increasing the net operating income, which is actually net operating income is very simply the income minus the expenses. That's where it is. Without taking the mortgage, that's the number which is called net operating income. And then, of course, the cash and cash is after we pay the mortgage, after we take out the CapEx, all that,
Right. Do you want to touch on just briefly on what you look for in a market? You mentioned the emerging markets and what you look for when you're underwriting a market.
Totally, totally. Darren, we are looking for jobs, jobs, and jobs. The key factor in any market, like in Houston, for example, I would love to share. And I've been there 4 years now in Houston, but mostly people were buying in Houston, north of Houston, all the places. By doing a lot of research, we found out that south of Houston is going to really grow in the next 4 years. And by golly, that's what it has happened. Now I'm selling a property for 8.7 million that I bought for 3.550 just 4 years back, 3.5 years back. I've got another property, 8.7 million I bought it for. It's worth 12.3 million today. So the emerging market is really big. It's where the jobs are coming. With the jobs, the households come, and with the households, the income rises, and that's where you can have more occupancy. When there is more occupancy and less unoccupancy, occupancy is the
Vacancy.
main factor, and then you can really give value to the property by bringing, cafes and dog parks and lots of different things. Then the residents don't mind paying more and more and more with inflation also and so forth.
Is there a population size you look for?
That's a good point. I have lived actually with 100,000 plus areas, I would say. But in the last 4 years, I've gone down to even 25,000, 30,000, in the town, just because the jobs were there. And that has helped quite a lot, because especially if you are in a nice metro area like Houston or San Antonio or Dallas, Fort Worth, you can't go wrong. Atlanta. So we have stayed true to very close to in the tertiary markets of the major metropolis. We don't go too far out, like 2, 3, 4 hours out. I have not purchased. I just feel like there are so many predictable factors if you're far, far away from the metro area. That's what, I feel. The biggest thing is Chamber of Commerce, meeting with the Better Business Bureau, wherever we feel we want to stay. Like, for example, I just purchased, oh my gosh, I wouldn't mind sharing it with the investors. They should invest with me. I just bought a purchase 11 months back for $12 million, 191 units outside Atlanta. It's southwest of Atlanta. And my broker just sent me BPO. He says, Vinny, I can sell it for 2.5 million more what you paid 11 months back.
Wow.
I mean, that's emerging. That's
Mhm.
emerging market. And it took me 6 months to really combine so many reports from operating memorandums, talking to brokers, because who knows the emerging market best? The people who live in that market. So when I moved from Texas to Georgia, and I'm buying everywhere now, and North Carolina, and the thing is, you got to talk to the property management companies, the brokers, look at the operating memorandums, because they have to write a lot of data about that particular market to bring the investors from California or Florida into Atlanta, right? So those operating memorandums, about 10 or 12 pages long, will be all the statistics, all the data, why one should buy there. So that's where I look at a lot of data. Then I go and do research, my team does, and they put all the different all the different economic reports are the words, and we put them in Dropbox. And then we start softening our investors why Vinny's going to Atlanta to purchase. And when we bought the properties, two of them, I raised $8 million within like a week's time. 1 week it took me, not more than that. I mean,
Wow.
6 million was raised in 2 days, and then 2 million after that.
Got it. All right. So you've established the market. You've underwritten the market. You found there's jobs, as you've indicated. That's kind of your lead underwriting factor.
Sure.
It sounds like.
Right,
So
right.
if you've got
Jobs.
jobs, then you look in and find population and the the occupation or occupancy versus vacancy. Assuming then, also look in the rents and supply of housing
Correct.
and so, and you establish your team. You talk with the Chamber of Commerce and property managers and brokers and all that. So you've underwritten the market. Now you've got a good sense of things are happening, right? There's opportunities in the marketplace you're in.
Exactly. I mean, certain areas, if the new motel or hotels are opening up, Starbucks are coming in, new businesses are being developed, strip shopping centers, all those are indication of path of progress, I say. And many times by going to the building permits at the city, you can find out where these things are happening. And majority of the people that I just mentioned, real estate commercial brokers, residential brokers, even loan brokers, by the way, local loan brokers will also kind of give you some perspective where they are writing loans, in what market people are buying. They may not tell what properties, but they could give you indication, you know,
Sure.
and so forth. So now we talk to the commercial brokers and ask them to give us deals, pocket listings, napkin listings, like I call it. And I got, like, just to take an example, in Atlanta, 92 deals. After I went there 4 days, met with all the brokers, they started feeding me some pocket listings, some outside listings, and 92 of them. And then
Wait. How long were you there?
I was there 4 days,
And you
just
got
4 days.
92 listings?
Yeah, I mean, in the next 3 to 4 months, I got 92 listings sent to me, and I
Wow.
kept in touch with the brokers, Darren, every 10 days, through texting, through phone call, through sending them some articles, through email. I mean, you got to really clobber them, let them know, hey, you're a performer. I was a performer in Texas, but I was just entering Atlanta market now. So I was a newbie, right?
Sure.
Yeah.
Let me ask you, when you're having that conversation with the brokers, have you come to them with a kind of a buying criteria, what you're looking for?
Oh, surely, definitely. See, we don't want to waste their time. They will turn us off. I mean, they will put us right at the bottom of the list if we are not good to them, first of all, and then give them specific, parameters. I'm looking for C plus or B asset in a B or A area. That was my parameter. I am looking for 150 units or more. 150 to 400 units was my criteria. And that's all it is. And then I told them, these are the towns I would love to buy in. And by the way, I will compete it, paying 120,000 a door, 120,000 a door for $24 million, product near Dunwoody in north of Atlanta. Nice school system, everything. But 13 offers came, and I was in best and final in the top two, and I lost at the number two spot.
Wow.
I know.
Wow.
But I don't mind going in there with some hard money and all that. But then, I'd never give up. That's the other part I would love to tell your audience. Persistence, perseverance is so important. Positive attitude and just grinding it. I mean, it took me a year. Look at it. It took me 1 year to buy my two properties in Atlanta. 1 year.
Wow.
You know?
Well, but sounds like you were getting opportunities. Clearly, 94 properties to look at, and in a few
Mhm.
months, you caught the attention of the brokers. And it sounds like, again, your track record probably speaks volumes to that. But
Sure.
the fact that I'm assuming that you came to them with specific, uh, items that they could identify, and they knew what you were looking for.
Mhm.
Plus, your proven record probably was encouraging to them to try and find something
Sure.
that would fit your buying criteria. So, all right. So let's talk about this. So you're talking with these brokers. What are they bringing you, and what are you underwriting once they bring the offer to you?
Perfect, perfect. As soon as they give me the address, of the property, and maybe the P&L comes a day later or 2 days later, profit and loss statement, and the rent roll. That's all I need. I need the address to really put it into Google. Google is my best friend and everybody's friend. I mean, they will tell us so much about that property just from the address. We could go to Google Maps, Bing Maps, look at 3D pictures, look at the neighborhood, look at what's adjoining, what's behind, what's front, and you could even go closer to the property. I always ask the broker, please give me 200 pictures. I'm in California near San Francisco. I've been operating 12 years right from here, and I only travel maybe once every 2 months. So about 6 to 7 trips a year. I go to Texas and go to Georgia. Majority of my things are done remotely. It's so great because I have teams there on the ground. But brokers, especially the one I bought in Atlanta, within 45 minutes, my broker called me. He says, Vinny, I'm taking pictures. I'm going to drop them in the Dropbox, 200 pictures of all the buildings and roads and neighborhood, everything, swimming pool, all that. He dropped it in the Dropbox within maybe 1.5 hours, I would say. It's amazing. I mean, how much it would have taken me to find somebody over there to go get pictures. So we need to really kind of help the brokers sell better and easier. And that's what we did. We underwrote the property. Yeah, no, go ahead.
No, I just want to ask you. So the pictures they're sending you, are they primarily the surrounding area and the exteriors of the buildings? Are they getting into the interiors? Are they giving you?
Okay. Good point. Yeah, the interiors, we didn't get that many in this particular case, but I go on Google to go to apartments.com. 81% of the residents, we never say tenants, residents who are looking to live in Atlanta, they're going to look into apartments.com. It's going to come right on the top. So looking at the address, we could go there if there are 10, 15 pictures already
Right.
of the apartment exterior, swimming pool, leasing office, interiors also are there, by the way. And 3D are also there in apartments.com because we use them too, for all our properties. Then I look for the name of the property. Once I find out from the address what's the name, then I look for the Facebook pages of those properties. If there are other apartments ratings, I mean, a lot of disgruntled people actually write on apartments rating. I give a little bit weightage to that, not too much, because I'm going to bring value to that community. I'm going to bring my own team of people to make things happen there, right? Even if people were disgruntled. So those things help. But then the financial is the big part. That's what we want to dig into today. That is where you want to look at if there is a pocket listing like the one I'm discussing, just the profit and loss statement is coming to us, we need to make sure it's 12 months first. Sometime the P&L comes 13 months also. It may give you the current and plus add 12 months into it. So we need to look at only 12 months. If we get only for last 5 months P&L, we need to total up all the columns and then divide it by 5 and then multiply by 12 to come up with the annual numbers. That's the big thing, right? And now we need to start putting in the worksheet, how is the property performing? How much collections have they gotten? In collections, please look for concessions. Concessions, if there are a lot of concessions, it means the quality of the residence is not that strong. If they have to give concessions, I believe, then you are getting some lower tier, residents to come into your property. You have to pay them concession to come in, to live in there. Secondly is the delinquency. That's a huge number. That will tell you also the demographic, nature of the residents who are living. If the delinquency is very high in the profit and loss statement, that is a red alarm. That's a red flag. Also, we have to see how much income they are getting from RUB system. What are the other incomes that are coming into the community? Are they billing back? We are able to bill back 90%, 85 to 90% of the 150,000 or 200,000 we spend for water, sewer, gas, and trash, and then the pest control. It's amazing. Even though the residents pay for electricity, which is fine, individually metered electricity, they have to pay for that. We pay for the common areas of the apartment complexes, but we do need to really look into it. Every state allows us to bill back the residents a flat rate, or we can do proportional to their size of the square footage of their apartment. There are third party companies that you can give the bills out to, and then they will figure out the billing per resident. We used to do it, Darren, but we have gone to a flat rate, and the residents love it. The flat rate is much better. Then the future residents also can see how much to allocate, towards those.
Right. No, I've found that myself. The just a solid every month same number as opposed to up and down.
Sure.
So when you're looking through this, I mean, you mentioned a couple things that are like red flags. Are any of those red flags? Do they also spell opportunity? If
Yes, they do.
you see something that might be out of round or not what you would expect, does that get you excited, thinking like, oh boy, we can, there's an
Totally.
opportunity here.
Yes, definitely, Darren. I mean, again, concessions are given to bring people in. We don't like to give concessions consistently every month. So that's the thing I like to look into the profit and loss statement by month. Okay, did the concession start in January and ended in February? So there were a lot of concessions, but then March, April month, maybe very little or zero. Now that tells me then, okay, maybe at that time they were going through some renovation or thing. I like to know the story behind the sale. I like to know how long the seller has owned that. Is he a flipper? Did he just buy it a few months back or last year and he's trying to make quick bucks? He's trying to put the lipstick on the pig, I call it, just to kind of color outside, exterior paint, and not much inside. I like to look for deferred maintenance, of course, and also capex. I asked the broker, could you please ask the seller how much they have spent in the last 5 years? Because that will tell me how much they've spent on boiler system, on roofs, on parking lot, on the sewer lines, if any, air conditioning units, the condensers, and all that. Those things are the major ticket items. And I need to allocate in my underwriting all the costs. I call it deferred costs. Would it take me 200,000 or 500 or a million? I have underwritten as much as 900,000, which I raised the money from the investors. If I don't raise that money, my cash on cash in the Atlanta deal was 19.7%. 19.7%, the one I bought for around 40,000. Here I was trying to buy 120,000 and I fell in my lap 40,000 a door, you
Wow.
know, a pocket listing, because the broker kind of felt the need that Vinny is sincere. He sent me a few things, but then this one came. I was in Hawaii. He just texted me, Vinny, do you want this? Over 200 units, blah, blah. And the rest is history. I locked it in right away. I said, yes, I want it. And then got my due diligence team and so forth. That property in just 11 months, another property across the street sold for 53,000 a door.
Wow.
53. I paid
Wow.
37,800 for it, and I'm renovating it. Units, and making it really very beautiful gated community. We just got that contract. Yeah. But let's
Well,
talk about. Oh no, go ahead,
no,
please.
no. Let's talk a little bit. So you've kind of gone down and you're looking at the individual numbers on the financials, and
Yes.
you're looking for something that you mentioned, like concessions. If there's, if they're consistent. You mentioned, we talked a little bit about utilities. If What are some numbers you're looking for that are specific? That, I mean, or is there anything, or is it just you're looking down the whole laundry list and you have kind of a sense of what they should be? And
Correct.
if you see something that's like, setting off an alarm, like, can you describe a little bit about like what you find and what you found?
I would love to, Darren. And as a, thank you to your listeners listening to you. We would love to give them like my 1.5 hour recorded session of the underwriting. Not only I go over my underwriting and every part of it, but also we'll be giving them the deal analyzer, we call it, $200 worth. But then also the, reports or the videos that will make it a lot more sense for them to underwrite the deals the best way they can. You're right. In our underwriting, we have the seller's columns and our columns, Ours are how we will operate the property. Seller's columns are what we see on the P&L, on the profit and loss, because we do need to see the history of this apartment complex. How much was the utilities, how much were their different like repair and maintenance, how much they paid in taxes, how much insurance, how much was their payroll, how much they paid in management fee, how much they paid for contract, services, lawn care, all that, landscaping, pool, all that, how much did they pay, all those are very big generic items we look at. And then we compare that and see, okay, when we take over, what will we do? Rule of thumbs we have. So we'll be saying, okay, here we can cut the cost, but here we cannot. Here it's going to, like utilities, for example, we could train the residents to use less water, to use other, means of reducing, all these gas, trash, all that. But then at the same token, the one item which makes a big, big difference in our underwriting are the taxes.
Yep.
How much the taxes will have to pay because of the mill rate. We'll go to the assessor's office and find the mill rate. The seller might have bought it 20 years back, that property, or 10 years back. Their basis will be so low, they're paying so little tax, but our could be 5 times as much, So that's a big one. The other thing is the insurance. How much are they paying for insurance? Any lender will like to get the maximum insurance for the property and all and everything. So it's good to have insurance numbers from the insurance broker. In our company, we do master plan for our whole portfolio. So we get very good rates, So, but that's what we look for, the
Gotcha. Hey,
other, no,
I
go.
just want to ask you real quick. You mentioned CapEx. You like to see what the seller has done over the last 5 years, give you some sort of a sense of things. Is there a number that you find that you use as a rule that you underwrite to when you're buying a property, or how do you account for that in your numbers?
Good point. Very good, Daryl. Again, the thing is, if the property is really good,
Hmm.
neighborhood is good, and you think that it's going to grow in value, then more capex money can be allocated to it. Like, for example, the one I just shared about 38,000, 37,800. I raised 900,000 from the investors on day one, and then it flowed. It gave me 12.4% cash on cash. After counting 900 in the cash on cash at the bottom, I added that 900. Then due diligence, when I did it, I got 450,000 given to me at closing also by the seller.
Based on what you found in the due
Exactly.
diligence there, and you were able to then come back to them and say, this is worn out, or this got to be
Yes,
replaced, et cetera.
totally.
Um, so on that though, you've got their history. You can see what they've done.
Yes,
You can assess that compared to what you are going to have to do.
correct.
Ask for a discount at the closing, or not at the closing, but just to
Yeah,
make the
at the
numbers work.
closing.
Yeah,
No,
post
you're
closing.
right.
Yep.
Because see, the seller wanted to reduce the price. I never want to reduce the price, because if we reduce the price, my appraisal is going to come about that much or more. And then 80% loan, what I was going to get in cash, now it's given into a loan and so forth and down. I don't want that. So I wanted that 450 given to me at closing. And there is a distinct advantage of that. I have that money sitting in the bank to invest it into the asset. you know.
So
So,
interesting. So what you're, and this is a great point to reiterate here, because I think that the novice, and I'll put myself in here, I've had situations where there was either, I don't know, deposits or partial rents or whatever, and somehow the bank took that as like that was part of the fees for the closing, as opposed to just, that money for the operating capital, or even like you're saying, though, what you stipulated with the seller was that at closing you would pay the original price, but then he would return to you the,
totally.
yeah,
Yes, sir.
that's
Yes, sir. Right, Darren. I've done it several times. Again, you only look for repair allowance when it's needed. I mean, you don't
right.
want to be paying in, anything to the broker or the seller. I have had another time when I got 250,000 at closing, but this one was my highest amount, 450,000. You're right. You want to get it at closing. In other words, what that means is actually in the closing statement, they give you a credit already from the amount due to send to the title company. So the 450 stayed in my bank all the time because I had to pay less at the closing. So
Wow,
that's the way to
that's
do it. And even finance, some of the, now when you're saying financing the costs, that is true too. If you want to have the lender finance the cost, that's better for you, because now when you send the money to the escrow agent or title company, you will pay less because the loan includes all the costs
closing
that you
costs, right?
pay. Exactly.
Right, right,
That's it.
right, right.
Yeah. Yeah.
Okay, and I want to make sure we'll list the link in the show notes for our
Please,
listeners,
no, please.
so they can get your material there on your underwriter and deal analyzer and all that
Totally.
stuff. So you go through this, you find your numbers, you do the side by side comparison, the seller's numbers to your numbers. You come up, and I'm assuming that at that point you realize that either the number that you've agreed to in principle on the purchase and sale agreement, now you have to adjust it. And do you primarily do that through the credit at the selling, or at the closing, or do you ever look to reduce the price?
Okay, good point. Very good point. Actually, in my new book coming up, by the way, Darren, want to put a little plug in there. I'm explaining a lot about what goes through psychology of the seller. See, seller wants the maximum amount of money. He wants to actually uh, charge you, what the sales price was when we accepted the offer. The big thing is into the 21 days or 30 days that we have for due diligence, we need to get on day one due diligence team over there. If it's my own team, my own managers, or I hired, like in Atlanta, I just starting brand new company there now. So I hired the due diligence team, which I got, by the way, network through the brokers. I kind of texted them, hey guys, I want to really need your help. Who have you worked with who is really good? And I came to know a company, 42 years. They have been doing due diligence for apartment complexes. What a great opportunity. So I got them hired right away. And then within about 7 days, we found out the different maintenance and other things. And I talked to the owner of that due diligence company, because they were going through every single unit. We inspect all 100 units, 100%, units, so that we could see the insights. And then I started writing my repair letter to the seller right within 7 days, even though I had 30 days of due diligence. You got to start talking to the broker. Hey, the things are not looking as rosy. I want you to come and see for yourself, because my listing broker is my broker too, by the way, Darren. So I never buy from a buyer broker who brings the property to me. I have always purchased in the last 12 years. I decided, because I'm a broker too in California, I could take hundreds of thousands of dollars of commission as a referral fee legally from my sales. But I never take that, never have taken it. but I give my commissions back to the selling broker, listing broker. They love me because then they make double the money, right? So they have the fiduciary responsibility now to the seller and to me as a buyer, and we want a win-win-win-win situation there. So that's why it's so important to talk about the repairs as soon as you start due diligence. If you find it, if there is everything looking good, like in my second property I bought, 191 units in Atlanta, I didn't have to ask for anything, because everything was looking so beautiful. The brick homes, the townhouses, everything, very nicely. Deferred maintenance was not there, all that stuff. But it's good to really write that letter right away. And then within see, the thing is, I've been caught in that, where I waited till the 27th day of the 30-day due diligence, and now I send a letter. The seller has a choice to accept your offer, to give you repair credit, or walk away. He
Right.
can actually let it go, and you can nullify the contract, get out of the thing. But if it's a great product, great property, you don't want to give it away. I mean,
Right.
you're trying to get that money to help, close the deal. Yeah.
Right. Let me ask you, is there something that you've found in your underwriting that you were surprised by that you can share?
Oh, sure, sure. I would say payroll. Payroll is one thing. Lots and lots of sellers like to put it very less. I have found, they say, oh no, we are managing, we are self-managing. Many times in their P&L, management fee is zero, you know, and they say, oh, they show you net income and NOI, all showing very high number because these two columns are less, Of course, the taxes will be less, right?
Right.
Insurance will be less. So you have to be really watchful. What you're looking at is what these numbers mean or don't mean, because you have to put your numbers in the worksheet, like I explaining. You got to put your number, and you have to look at each and every category, not to miss anything.
Right. Let me ask you another question. Is there anything that previously you didn't pay any attention to, but now all of a sudden it's one of you look for, first because of a lesson you learned?
Yeah, sure. I would say definitely, Darren, I would say since we have been purchasing C plus and B assets, and they are 30 years old, 40 years old, like that, we need to be doing very proper due diligence. Not only the numbers need to make sense, and if the numbers make sense, the property exterior makes sense, we need to do complete due diligence to look into the sewer systems, have the plumbers drop the cameras in there to see if the sewer systems have fallen down or there have been any crack in foundations, the boiler systems, the roof, the tiles, the whole structure. I always say, never marry the property, but only marry the numbers. But I
Right.
also have to change that, and we have to say we have to marry the property too, through the due diligence. you know, we want to make sure that this is a good thing, because it's like a marriage. You cannot get rid of a property so quickly, because if you just closed on it today.
Right. Right. No, you're in it for the at least for a period of time. I mean, you got to
Yes.
plan on that. And what is an average hold time that you plan for?
Surely, we look for 3 to 7 years, actually. We have, I mean, in the fund we are doing now, $50 million fund, we are even going as long as 10 years. I know some investors have expressed to me, Vinny, why don't you just buy and hold? Buy and hold, keep it for life, right? But the thing is, many investors also don't want to leave the money you know, uh, in that investment for a longer period of time because of their age and other stuff and so forth like that. So we have really kept our, if we can make a couple of $1 million within 2 or 3 years, like it's happening now in Houston area for me, I'm selling 5 properties there out of 10. It's amazing because they have increased in value so much. And I would rather take that money to a new emerging market, because the thing is, in my thinking, I feel like market emerges, and many times there'll be cycles in the market too. So you have to keep in really good check with the market cycle and try to sell the property so that the other buyer will have more uprun before it goes downhill.
Yeah.
And then, I've seen myself happen that in Odessa, Midland. By the way, we are selling 3 assets now, and we made a lot of money. And then we went through that oil downturn, and now the properties are 98% occupied. And so I've seen the whole cycle.
No, that's great. Vinny, this has been, enlightening and very informative, and I'm sure listeners will agree. And I want to remind them we'll be putting that link in the show notes and where they can go to get your underwriting
Sure.
information and your deal analyzer. Where can the listeners go to find out and learn more about you?
Oh, sure. Darren, thank you so much for inviting me. What a great work you are doing with your podcast. They can actually reach me at vinnychopra.com, which is my website, Vinney Chopra, Chopra, vinnychopra.com, or moneilinvest.com. Monil is our kids' name, Monica and Neil. We combined the two to make Monil, MON, as in Nancy, EIL, invest, INVEST.com. And then, again, if you'd like to correspond with us, or they would like us to send free things, they could actually text the word syndication to 474747. That's another easy way to reach me. Just text the word syndication to 474747.
Got it. Vinny, as always, I've enjoyed it, and look forward to doing it again.
Totally. I look forward to our next chapter, Darren. I'm just totally excited, how you are able to dig into deeper, issues, and that can really make a big difference in doing the best underwritings and getting the whole syndication done. I definitely want to leave your audience with, syndication world has brought so much changes in our lifestyle. It's a great avenue to scale up. If we can have X amount of money and we can buy our own 10, 15, 20, 100 units, but with scaling up and helping all the investor friends around us, money is all around us. It's just we are the avenue for them, a vehicle to invest that money and get great returns, So syndication is a great world, and you will never go back to individual investing whatsoever. It's the first one is the hardest one, and we have done 26. I'm into 27th now with the $50 million fund, which will buy us another $250 million more. So we'll be about $250 million, $500 million, soon. Yeah.
No, it's exciting.
Thank you.
All right. Well, for our listeners, if you like the episode, please subscribe. And I want to remind you too, as we mentioned earlier, Vinny and I are committed to doing a number of these conversations where we dive deep into multifamily and all of the different aspects of multifamily. So if you subscribe, you'll be sure to catch all of our future episodes. And always, as always, if you like the show, please share it with someone you know. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.